Good afternoon, everybody. Welcome back to the Schwab YouTube coaching channel we call Trader Talks. Our next topic is building a stock portfolio. I'm your host, Kevin Horner. It's a rainy afternoon here in Denver, Colorado. Not that that's a bad thing. We always appreciate a little bit of weather out here, but we are prepared to get to business in review of both the market and our example portfolio for this class. So thanks to you all for joining us today. We are joined as well by Connie Hill there in chat. So you can say hey to Connie. She'll get to comments and questions I'm unable to get to, but on this fine Taco Tuesday, Cinco de Mayo, we will absolutely be watching the chat as well. Love to hear from you. Feel free to drop questions in there for the duration of our show. We always go about 40 to 45 minutes or so. Now, we've had a good market day today, broadly speaking. We're going to need to raise some stop orders, some exit strategies on some of our existing example positions. We also need to establish new trades for tomorrow's business. And we've got some trades that went off last week but did not stick. So we're going to keep an eye on those as well. I'm going to talk through that whole process with all of you. So if you're not already doing so, follow Connie and me on X, Connie Hill CS, Kevin Horner CS. We both try to post for you there throughout the week. I love bringing charts to the table there. Posted a number of them today with some key moves and some hot stocks, at least some stocks that are moving, I should say, not hot necessarily, and certainly not recommendations for all of you, but always try to bring to the table some charts that are interesting looking, and that's where I find the most engagement from all of you as well. It seems like that's what y'all are looking for. So with that, let's get to our disclosures and we'll dive right into things. So please remember, everything we review for you today should be considered informational and educational exclusively. We will not be making recommendations. We will not endorse a specific approach to trading. We will use technical analysis, though, as we review these positions, we also review the broad market, and we will bring concepts that traders might add to their own planning processes, but that whether you choose to do that or not is entirely at your discretion. So as always, make sure you do your due diligence as it relates to building your plan and working to stick with it as well. So beyond that, I will mention our process will have us basically reviewing the market activity here to get started. So we're going to do a brief market overview from the close, and then we're going to look at our existing positions and build out new ones. So let's get started with the S&P here today, as I'm going to bring up the thinkorswim desktop here. And so what we've noticed in the S&P 500, everybody, is more of the same. The thing that did not play out, interestingly enough, was this rectangle I've got highlighting the price action from Friday, which looked a bit like a doji or a dragonfly doji at the top of a move. And we've more or less negated that, it seems. We had the brief pullback, and boy, was it brief, lasted all of a day. And then we've got trading above the high from yesterday already. So, it's way too early to know if we can move to new highs, but we've kind of managed already through the price action we've seen the last 2 days to kind of eliminate this doji, this dragonfly doji here, and we'll see if that leads to more highs. You can see that our high for the day, if I lift off that, the high for the day basically was the same high from Friday's high. So we know what we need to get through, don't we? We definitely know where we want to trade above in order to be validating a potential breakout here in the SPX. Now, our big move today was, or I should say larger in the NASDAQ 100, and the move here looks pretty stout as well, doesn't it? A real nice springboard effect off of the lows from last week that has led to yet again new highs in the NDX. So the NASDAQ 100 trading at all-time levels. For those of you watching that 20-day, you're probably thinking, Kev, I can't give up risk to the 20-day. We're talking about 1,400 points in NDX points, that is, to the downside. That's the equivalent of a 5% move. That's a lot of points for many traders to give up if you're holding, a NASDAQ 100 position, for example. If you're holding something broadly that invests exclusively in the NASDAQ 100, it's a lot to give up. So the 20-day moving average might be too wide for a lot of you. It might be the 10-day moving average. Notice that if I just take this line here, activate it and put it up to the next level, it kind of coincides right there, doesn't it? And now that's looking a little bit better. And if you were to utilize that, I wouldn't fault a trader for doing this level for trade management instead of the 20-day if they're looking at this, because simply put, you're just looking to capture a greater percentage of your profitable move. For a lot of you traders, if you just were using the 10-day moving average as the impetus to take action, you might have felt really good in this 4-day window right here, and yet you might not have been necessarily comfortable taking position there. I think the spot where many traders would have suddenly become comfortable might have been something like this. This spot in here, the gap move up. And then if you'd have taken it from here, that's a pretty healthy move, still 13%. So again, be thinking about where is it we can go through our management process. This class in particular, our goal is to hold whatever it is we choose to utilize for our example portfolio. We want to hold these positions as long as we possibly can. And so determining the trending moving average of import for the security we're working with or the instrument we're using, in this case, the NASDAQ 100, it's imperative that we are consistent and we are raising our stops along the way. Remember, in this class, we raise stops. We do not take them off. We do not reduce them. Now, I did have a trade in our example portfolio that we need to re-add a stop on, and we're going to talk about that here in a moment. But before we do, I did want to hit the Russell 2000 quickly and just highlight the fact, boy, that is a pretty darn good clean breakout, isn't it, everybody? That's new highs on the Russell, busting out of a range. Let's see if we've already, I don't think we've already made the measured move target based on the range height here, everyone. But if I take that line and add it to the peak here, basically the level that we just broke, let's see. Well, it's pretty close. So that puts us up to 2860, about 15 points away. But remember, these measured move calculations, these are no means guaranteed to be achieved, but that's what we would be potentially striving for with the small caps. So again, management of the small caps looks stronger with the 20 here, being that we were consolidating for 2 weeks, allowing the 20-day to get caught up. This looks like a bit more of a solid area for short run support. Notice if I went with the 10-day, we've had some machinations beneath it, and a trader who wanted the 10-day wouldn't be wrong. Remember that when we're choosing a 10-day versus a 20-day, really it's about your comfort individually as the trader more so than anything else. But we also remind ourselves that we frequently will incorporate the average true range as to our process in setting these stops. So just keep that in mind as well. If you're thinking about the 10-day at 27.88, don't want to put our stop at 27.87, right? We want to go a good distance beneath that. And we in this class will frequently use that average true range. In this case, the Russell, the average true range of the last 3 weeks approximately is about $42. So you would want to come beneath the 10-day by that amount. 27.88 less 42 puts you around 27.46 approximately for a potential stop. And then, it's always helpful when you're thinking about that, go ahead and just look at where that lines up on the chart. Because one thing that's interesting about the math that I just did, that little back of the napkin math, I like to call it, if you were looking at 27.46, well, that means that you'd be selling before we broke horizontal support. And perhaps the trader says, you know what, that's only a difference of 6 or 7 points, maybe 10 points. I wouldn't want to sell before we made a new short-term low. Could be a thought that a holder of the Russell 2000 positions might say they want to stick with, right? They may want to hold all the way as long as this horizontal support tested at 27.40 holds up. And so even though your math might say 27.46 is the spot for the stop order, be aware you might want to give consideration to putting the stop below the last low. There's always a way to massage our thought process and our trade exit strategy a little bit to build in a little more comfort or give us the chance to stick with the position a little bit longer. So hopefully that's kind of helpful for all of you. Okay. All right. So there is our biggest moves. We could throw up the semiconductors, see a significant snapback there as well, back to new highs, breaking out once more. But we just wanted to highlight the big three more than anything here today. So wanted to make sure we covered those. Now, let's look at what's gone on in the portfolio here, our example portfolio, since we last spoke last week. Now, the one thing we're going to start with is EXPD. We put ourselves in a trade where we were buyers on Wednesday morning of last week, and we applied a stop order immediately to that trade. So we bought in here, 50 shares, 147.91. We put a limit on it to be buyers as long as we didn't exceed 148, I think about, as I recall. And then we put our stop order beneath it, 141.20. Let's take a look at EXPD on the chart. Unfortunately, in this case, it just went against us very quickly, and that took us out. So we had the earnings call here that came ahead of market here this morning, and that led to a significant gap. But Friday's price action, for one reason or another, completely kicked us out of the trade. So we built the trade properly, and the trade didn't work in our favor in the time frame we had hoped, and we got stopped out. We ended up losing about, what is it, a little more, almost $7 a share on our 50 shares. But that did not exceed our tolerance for risk, which we limit to no more than $1,000 on any one trade. So we lost an amount with which we're comfortable losing. We recognize nobody likes to take losses, but we built the trade with our process and our plan. It just didn't work in our favor this time. So that's going to happen from time to time. So that's the big thing that occurred here in the last week, at least the position that we established and did not maintain. If I go ahead and change this, take off this symbol here, we'll see that we did have a sell last week as well on the position in Halliburton. So let's look at that in our example portfolio. Here we are. So we had a bracket on this, everybody. And because we had a bracket, the stop order fell off. And so one of the key reminders here is that we need to replace our stop order. What we did on HAL was established a new position a few weeks back for 275 shares. I'm going to show you all of these trades here. So we're going to go back to, I think we have to go to probably like 50 days just to be safe. Okay. Yeah, okay, so back in March, we picked up 275 shares at 35.41. We established a stop exit beneath us and a limit exit above us. And then last week, we made an alteration to that order. We were going to sell all 275 at our limit, but we said, you know what, let's go ahead and change that. And let's try to make sure that if the stock is going to keep going, let's try and participate in that. So we changed it to sell only 175 at our limit, which we did. Now, the difficulty is that we have to find the next level and put a stop order in there based on the shares that we have sold for profit and the profit we have remaining, not wanting to turn a winning trade into a losing trade, right? So here's what we're going to do. We're going to talk a little bit about what the price action looks like up here. Still has a bit of a bull flag situation, right? I mean, here you've gone sideways a little bit for the last 4 days after having broken out, but a lot of traders are going to be enthused by the fact that since it's made that new high, it's held the ledge. For many of you who watch this show frequently, or maybe the Trader Talk show frequently, you know the next conversation here is around confirmation, right? Do you define confirmation as holding a breakout for 2 days in a row, 3 days in a row, 5 days in a row? Maybe it's more, maybe it's less. The point is, if it's something between 2 and 4, well, then you may very well have confirmation on the breakout here. And for some traders, that means that they believe the path of least resistance now is still to the upside. So what we want to make sure we do, by the way, I did the math on this. We got a little bit more than $1,000 in profit on that first 175 shares that we have sold. And when we look in our Halliburton position, we've got another $600 in profit. Now, I'm not talking about the profit other than the standpoint of the math so that we can make sure that we capitalize on this trade, because we have split the position out. We've taken $1,000 in profit off the table. We have some very big wiggle room with which to work here. So on 100 shares, we can decidedly just set this $600 of profit, which we have not taken. This is unrealized profit, right? So we've already taken out $1,000 in profit, put that balance of cash back into the cash availability for us. Now, if we are willing, we could give this stock all the distance we want back to our entry essentially and utilize a stop exit beneath or near our entry price. And then if we get taken out, we still made the money we made on the shares sold and we break even on this 100 shares. What that could do for us is give us the opportunity of sticking with the trade an even longer period of time. But there's one other key component here, everybody. We in this class frequently we use the standard stop. The idea being we trigger and we set the trigger price. Once triggered, it becomes a market order to sell. But then we have to make the adjustments along the way, right? Well, what if we decided because we're such in profit and we can give it a little wiggle room now, why don't we do a trailing stop? So we've not done a trailing stop in this class previously. So I figure this is the time to take advantage of it because we have a trade that's already worked in our favor. We have a balance of profit we've already taken out of the trade. Can't lose the money we've taken out, right? Because we haven't redeployed it. So let us give this as much wiggle room as we can and see if it can still keep going, then maybe we can continue capturing upside. The nice thing about the trailing stop is it ratchets higher automatically with price. So if price makes new highs from the moment we set the trailing stop amount, and the amount we're setting is the distance, by the way, the distance between the highest high the stock makes and where we are willing to exit, well, then we have the opportunity to capture more upside. Okay, so that's what we're trying to accomplish here. Now, one consideration might be to look at the distance from the last trade and say that 50-day moving average, as we know that a break of the 50-day would be significant from a trend standpoint, right? We've been talking about that in here in this class since we broke it back in October. We have tested it a few times, and that has been excellent for support. So we don't know that that's going to hold, and it won't guarantee that we stay in the position, but we can give it enough wiggle room that perhaps we can stay with it for an even extended period of time versus our expectations would normally be. So one other consideration here, of course, it's the average true range. The average true range is $1.25. So, if I went with, say, 2 ATRs on this amount, or perhaps 3 ATRs to be $3.75, we run the risk of, at some point getting taken out, but we are also comfortable with the idea of being taken out. We basically are going to use an amount by which we're okay to see some fluctuation. And if the breakout here is valid, well, then chances are that we've got a better shot of more upside perhaps than downside to the 50 days. So maybe you can wiggle this or play with the values, I should say, the wiggle room I'm referencing here a little bit more than you might normally do so, because with distance is about $4 here, right? So think about that process when you're building this in for yourselves, okay? We're going to go with, I think that $3.75 makes sense for the trade. So we're going to try doing a trailing stop that way. So on HAL, here's what we're going to do. I'm going to go back to HAL here. I'm going to right click. I'm going to create a closing order with a stop. Change this to good till canceled, and then change order type to trail stop. Now, the trail stop can be by the amount by a trailing percentage if you prefer. I'd like to do this though with the dollar amounts, and as we said, I've done a little bit of this math. So what we're going to do is a trail of 3.75. Now, what's going to happen tomorrow, the open of business is going to start trading on Halliburton, and the very first trade of the day is going to establish as the high because that'll be the first trade since we have turned on or activated this trailing stop. So there will be what's called an initialization of price, and we'll reference that, and that whatever that new high is, we'll set it, and then your stop will be set $3.75 beneath it. And then if that new high gets exceeded by 25 cents, for example, well, then your stop order ratchets higher by 25 cents as well. So this is going to work as a means of trying to keep us in the trade just a little bit longer. And I wanted to reiterate the reasoning behind going with the trail stop here is twofold. One, of course, I wanted to highlight the process, make you all, give you all something to be aware of, make sure you're familiar with the stop. But number two is the fact is this position has worked well. We've taken money out. And because we've turned a profitable trade and withdrawn enough profits, then we can afford to give this stock and sit on it and give it all the time it wants if it's going to keep running. We don't know if it's going to keep running, of course, but if it does, then we get to participate. All right? So go ahead and confirm and send here. Again, we are putting in a trailing stop for $3.75 beneath the highest high. Going forward, this will initialize at market open with the first trade in Halliburton tomorrow. And so then that position will be at least set up and relatively speaking protected. I do need to remind you with that trailing stop, it still is not a perfect order. So even when we trigger, it becomes a market order to sell. That means we can't guarantee price, right? But we can say that our trigger will always be going forward. The trigger for this order will always be $3.75 below the highest high Halliburton makes going forward, beginning with tomorrow's open. Okay, hope that was helpful for all of you. Now we've got that Halliburton sell in there, feeling much better about it. So we're going to quickly check on our Fastenal trade. The stock is in a loss, so that probably means we don't need to make an adjustment to our exit strategy. But boy, has that level been sound, everyone. Look at this. We have that stop in at 43.43, and we missed it here. Our low was 43.47. We didn't get stopped out here. Our low was 43.52. Low here was 43.64 and 43.62. So we have managed to set that stop level pretty effectively. I'll remind you how we did it. We just incorporated the average true range below the 200-day moving average. And so far, so good. We're risky. I mean, this is it. We're not going to make a change. We've been to that level 4 times. We've been close to getting stopped out. We have risk for getting stopped out, obviously. But the reminder once more, we do not change our stop order lower. We never reduce it. We shouldn't pull it off either. So we leave it on as is. If we get stopped out, so be it. It's the cost of doing business. Okay. Let's see, Scott, does a new high get established intraday or only? Good question. Scott, the trailing stop will continue to establish new highs as they print. So if minute by minute your stock is running to the upside, each new print high is going to allow the system to ratchet your trailing stop higher. So it's going to ratchet with it every step of the way, penny by penny. Okay. And that is the benefit of the trailing stop. I commonly don't get to highlight them here because we don't commonly end up with the position in a lovely profit scenario like we did with the Halliburton trade so well. So I wanted to make absolutely certain we talked about that. More questions, obviously, bring those to the table here. Okay, next up on the example trades, we're going to check out EW, Edwards Life Sciences. Here we are in a bracket situation, so we are protected. We are utilizing a stop order that's pretty good distance now. The average true range on EW is about 252. And by my quick look at things, I believe we took the low here at 77 approximately, and then took the amount of 226 beneath it, which gave us an exit around 75. But because we don't like round figures for stops, we came beneath it. We went with my graduation year, 74.94, as the as the amount on that one. So we are capable of raising our stop. The question here is, everybody, do we like the price action so much so that we want to raise the stop to a level that would be one ATR, perhaps beneath the confluence of the 20 and 200 day moving averages right here? Or we could just use the 20 day. The 20 day today is 81, yeah, 8103. So we could use the 20 day and go beneath it by 252, and we could ratchet our stop order higher that way. But we could also just say, you know what, for the time being, because the stock hasn't broken out and we've got the order to sell half at our limit up there at the same highs we've achieved previous, I think it makes sense to let this one go. We are comfortable. We don't want to see this become a loss, obviously, but we are comfy, and we've got a good shot now, a better shot today than we did 2 weeks ago, of seeing the 87 level, at which point we'll sell 50. Let's take a look at this real briefly on the weekly. Okay, so that's exactly why we're looking to keep 50, right? Because if we sell 50 at 87 and it keeps running, well, then we might rally into the next level, which could be 95. And that seems like a wonderful development if it can break out. So again, what I like about this process here, everybody, is by selling some at resistance, you're going to be right either way. If it breaks out and it goes higher, you were right to have kept half of your position. If it stops rallying at 87 after having sold half, well, you were right to have sold half, because now you've pulled, as we watch the stock pull back, you sold half at a higher price. That's a great process, and it really I guess what I'm trying to say is it encourages us to take the process that we are using as serious as possible, right? We want to reinforce those positive behaviors. So those are good habits. Setting levels, not adhering to the emotion of the trade, not letting my emotions override my decision making. That's what we want to work against. So I think for now, let's let EW go, and we'll see if in the next week, maybe we get a chance to have sold some of these already at our upper level here. That would be fantastic, but we're not going to make any change on EW. PNC, we did just establish last week. Let's take a look here. We're pretty flat. We like our exit strategy here, generally speaking. In this case, we were above the 20-day, and we've used the ATR amount beneath the 20-day to set that stop. For some of you, the only negative in this case is the fact that the stop is above the 50-day moving average, but we are of the belief that we can hold the 20, even though we've been beneath it now 2 days in a row, actually 3 in a row if we count the close here, it looks like, on Friday of last week. So again, we don't lower our stops. So we're going to stick with where it is. Raising it would put us in a worse, more peril for getting stopped out. So we're going to keep this one as is as well. And then our last position here is on HPE, Hewlett Packard, and that trade has done wonderfully for us. Let's take a look at that. Goodness gracious, almost 1100. Okay, so we got into this one. Look at what we've got out of this. Goodness, we have to make an order adjustment here. So our ATR is only $1.04, and the 20-day moving average climbs aggressively to 27.15. So 27.15 minus $1.04 gives us 26.11, and we are currently at 24.99. So we can elevate our stop by $1.12. And nothing wrong with that, obviously. But you guys who are maybe feeling a little more confident or maybe less confident, if you wanted, there's another way to do this. The 20-day does look solid here, given our price action, given our breakout that we've seen over the last about 3 weeks or so. So we've validated this level here. If it will let me draw my line, there we are. This level is 26.35 or so. And then we've got a bull flag that has broken out. So you did this little quick flag and it broke out anyway. So you've got some choices, everybody. We are going to utilize the the 20-day moving average still, which is why we're going to raise it to 26.11. But don't hesitate to be more tight in your personal process. If you were the trader who said, yeah, Kev, that 20-day is way too much wiggle room, I got to go with the 10-day, then go with the 10-day. There's nothing wrong with that. The 10-day hasn't been spot on perfect, and you've had some machinations beneath it intraday. But a trader could use the 10-day, certainly, and use 28.56 and go beneath it. In fact, you guys want to do that? Let's do that. Let's just raise this one. So 28.56 less the $1.04 gives us 27.52. And just because, 52 is a nice round figure, let's go beneath it a little bit by another nickel. We'll get off that 50 cents. So that'll put us around 27.47. That'll give us an ample opportunity to capture more upside potentially, even though we know we can't guarantee price on this sale. So 27.50, let's go 27.47, excuse me. There we go. And keep that good till canceled, confirm, and send. Excellent. So gang, we're just working to keep as much of our trade dollars as possible. That is the game we play here. So we have raised our stops. We can try and keep these positions a little bit longer. So there's the adjustments we needed to make to our example portfolio. And I've got some new example trades for consideration here now. So let us take a look at a couple of those. I went and found two of them in the staples space. And again, this process is one that really is incumbent on us as traders to go through each of our watch lists as frequently as you can. What I noticed about the consumer staples space here, everybody, was the improving price action. Now, there is a level of resistance above us, and that does stand out. So we do have a potential band of pullback, a spot for a pullback in that space. But the thing that I wanted to work with here was locating stocks that maybe have not made the move or are at an area of trend support within their upside. So the two we're going to look at are in staples. First of them is Target. And so the reason Target comes up here, Target's had a great year. I mean, if we looked at year-to-date returns, Target's up 32%. That's great. I'm sure Target owners are loving that, right? Now, if we looked at the 20-day moving average, a lot of traders are going to fall into that because, simply put, the 20-day seems to be offering support in here, doesn't it? Some of you would say, yeah, the 20-day's fine because we've been above it so nicely for the last 3 weeks. But maybe the 50-day is more solid as support. And if I again pull off just the 20 so that we see only the 50, I think that those traders would be right. Look at these tests of the 50 or horizontal support. Those have been the most consistent. So the thing that tells me is, well, if we want to be a buyer up here in Target at an area that could be supportive, well, then we probably don't want a full position size. So we know that a full position would be about $12,000 for us here. So that would be a little bit more than we would want for our max position. So we'll go with, if we were going to do a full position, it would probably be closer to about 80 shares. So let's do 40, and we'll put our exit beneath the 50-day by the amount of the ATR. Okay, that's $2.96. So again, I'm going to use 121.30 as the 50-day moving average, less the ATR of 2.96, and that gives me 118.34, and that becomes our stop order level on Target. So here's what we'll do. We'll right-click in here, go with buy custom with stop. We're not going to bracket the upside. One of the reasons being in this case, Target's turning the corner out of a downtrend into a new short-term uptrend. Let's see if we can't give this as long as possible to rally. If it's going to do that, of course. We don't know, but that's what we're going to strive for here. So we're going to do 40 shares. We will buy tomorrow morning. If the price is better, we're going to give it, as always, the padded limit. So 128.82. Let's kick this up to 129.5. And again, we'll pay the best price. So even if it opens under 129.5, we'll get in at whatever the open is, lower than 129.5. But our max cost would be 129.50. We'll make that good for tomorrow's day only. Subsequent to that, we need our stop order to be good till canceled, and that goes in at 118.34. All right, so let's confirm, just make sure, buying 40. And again, the reason we're doing 40 is because the full position would be about 80 shares. And the other thought here is if we get down to the 50-day, so let's say we get weakness in target. We get to the 50, but we don't get stopped out. We get to the 50 and suddenly it holds support. And we say, oh, well, this looks like an excellent test at an area that previously has tested and rallied. Now we can add our second half of the position and let's see if it keeps moving up against that 50-day moving average. That'll give us the opportunity to dollar cost average in a little bit lower and also maintaining our exit strategy at a comfortable level. We are looking to maybe even have less risk with more upside, right? So this could be a way that we step further into this trade down the road. All right, now next up, same space is Keurig Dr. Pepper, KDP. And you're going to see why, but this one's a little different. So instead of being a willing buyer immediately here, and you could certainly justify it, I'm sure many a trader would say, hey, Cav, you're 8 days, 10 days above the 200-day here. This could be a way for a trader to build the trade. But I think that maybe the way is to be more looking at it from a breakout standpoint. Now, it's true the last breakout here didn't stick, right? But maybe this one would. And this would be potentially one of those about a $5 range. So the bottom down here is 25. And we had that double bottom. The lows back here were the same lows as we found here with a slightly higher RSI. And we've moved off of it quite nicely. But I think that this one would be more likely a buy stop order upward on a breakout. Now, that would be the trade if we wanted to go with it. But I'm starting to think that maybe instead, this is one of those, instead of a buy the breakout, we just maintain this kind of on the watch list. Like, come back to it. You know, there's every reason to think that there is a possibility for the breakout. So the traders we could absolutely put a buy stop here to buy as it moves through 30 to the upside. One of those ways to give consideration to that could be to wait for the stock to trade 1% or maybe 2% above that level. So 1% of 30, 30 cents. 2%, 60 cents. 3%, 90 cents, maybe a buck. So maybe it's the trader saying, I want to buy, if it trades upward through 31, I want to put a buy in there. That could be a way the trader goes about it. Okay. I wanted really to talk about it more than highlight the actuality of the trade, because I do want to get to, I did find a tech security here that I thought we could look at. All right, so let's do this. Let's put a pin in this Keurig Dr. Pepper, and let us try and place one on a tech stock, since I don't have a whole lot of tech. I've got one, just that HPE trade that's working in our favor. Well, the one I found here, and the main reason I struggled with tech, by the way, everybody, was as I was going through the list, I'm sure you're not going to be surprised. It's like we're just exploding to the upside. And we can trade these, of course. We can try and buy high and sell higher. But when you've had many of these positions make substantial moves already, it does give us greater risk to be buying at these elevated levels. We would much prefer to be buying in this period here, right? Where we see, Micron in this case has really just this 4 days where it just kind of went sideways a little bit before exploding, right? So, I like this, traders like this space due to the volatility, but we want to be buyers near the area of short-term support. And I think that's the biggest reminder here. So looking at Akamai, same thing, right? Explosive move. Qualcomm, explosive move, possibility to break out. AMD, as I see here, we just had a report. Looks like they're doing favorably after hours. But the one that came up for me in review of this group was VRSN, which had a quiet day, up about 0.5%. But it's had a good move. And the position itself has improved quite nicely. I'm going to draw a few lines in here for us. So we have a broken downtrend. And since the broken downtrend, stock has been behaving favorably, right? and we're in the midst of a possibility for a breakout. So we've tried to get through 277 or so. We have earnings already behind us. The stock saw volatility, but didn't bust higher. So we could trade this one for a possibility of a breakout. And, in this case, we do have some distance here. So, traders, how do you feel about the 50-day crossing the 200 to the upside like this? It hasn't happened yet, but this absolutely could be a zone for potential support. Maybe it's the 200 day. So the 200 day comes in at 256.33. And then the ATR on this one is 737. All right. So that gives us 248.96. That's a nice and odd figure, perfect for our process. 248.96 is our stop. Now, we know because this is a higher dollar stock, everybody, we don't have the ability to place a substantial position size, as we know. But we do want to do the math on that. So 248.96, and then looking at our entrance, probably need to give it wiggle room up to about 277. That would be $1.25. So if we are in at 277, we're risking 28 bucks a share, and $28 a share. As I go back to our reference sheet here, we can't lose more than $1,000. So 1,000, let me get my calculator to work here. 1,000 divided by 28 tells me we can own no more than 35 shares and stay within an approximation of our risk tolerance. 35 shares at 277 would be just shy of our $10,000 max position size. So we can go with it as long as we use the proper exit strategy. So we can do this one as a buy limit. Some of you traders might think about it as a buy stop, again, waiting for the stock to trade upward through that 277, 278 by a percentage of your choosing. We're going to do it as a limit because the setup looks relatively enticing. And obviously there's no guarantee, but this is an improving chart, so we're going to give it a shot. So we're going to go ahead with a buy custom with a traditional stop. We know our total is 35 shares at a limit of 277 or better. Again, always or cheaper. Exit strategy, good till canceled with a standard stop at the price. Oops, I made the mistake of a limit. Did I write it down? I did write it down. I'm proud of myself. All right, 248.96, everybody. 248.96, good till canceled. So we have the opportunity. If it breaks, this time next week, we should see the 50-day moving average a bit higher, and that gives us the opportunity to elevate our stop once more. So we're going to go with this for 35 shares. Notice this is basically a full position size, everybody. And then hopefully next week what we get is the notification as we talk that it's trading in around, maybe 300 or so, and we can start talking about a possibility for exit strategy thereafter. But what I like about this one more than anything is that we've stepped into the trade, or we've set ourselves to step into the trade. We're utilizing the 200-day moving average and the confluence around it with the 50-day moving average, and we've come beneath that level by the amount of the ATR, the average true range, once more working to stick with our position for as long as we possibly can. And with that, we are going to have to wrap it up, everybody. I feel like we covered quite a bit. So briefly, let's review what we've done. We did hit the market with a look at the S&P 500, the NASDAQ 100, and the Russell 2000. We also peeked in on semis, which just continue their torrid move to the upside. We also took time reviewing our example portfolio. We raised our stop orders where appropriate, working to capitalize on that. And the big takeaway is, as always, making absolutely certain that we have an exit strategy on these positions. All of these are protected with a standard stop order or the trailing stop as we have set up on Halliburton. I hope that was helpful for all of you today, being that we haven't used that one previously. So I was excited to make sure we highlighted and brought that one to the table for you. And then we also established 2 new positions, and we're putting a pin in the Keurig Dr. Pepper position for the possibility to check in on that one next week. So we'll take a look at KDP then. So with that, Thanks to Connie Hill in the chat. Thanks to all of you for joining us. Follow Connie and me on X, Connie Hill CS, Kevin Horner CS. I'm also now available on LinkedIn. If you'd like, you're welcome to follow me there. I'll be more than happy to connect with you. And make sure you keep it tuned right here to the channel. I know we're done for the day, but tomorrow morning I will be back. It's Wednesday tomorrow, so that means I'm joined by Brent Moores at Market Open for Trader Talk in today's market. I hope you guys have a great rest of your Tuesday. I look forward to catching up with you again real soon.